The success and failure of Bed Bath & Beyond. Due to declining revenues and 4 years of net losses, Bed Bath & Beyond has been having problems for a while. Their competitors have stepped up their game and e-commerce is growing increasingly popular. In an open letter to the board of directors, Ryan Cohen, the founder of Chewy and the chairman of GameStop, criticized the CEO and urged that the company modify its strategy. Additionally, he acquired a 9.8% stake in Bed Bath & Beyond, and considering Cohen's reputation with GameStop, retail investors grabbed the opportunity to purchase the shares, leading to a more than 60% increase in the share price. However, the share price began to surge once more in mid-August, tripling from its most recent lows. Ryan Cohen seized the chance to sell all his shares for a $68 million profit. Now, some are urging that Cohen be looked into by the SEC for market manipulation. So, what actually happened? Why did Cohen sell all of his stock in the company in a matter of months if he had a strategic plan for the company? Does the struggling retailer have any hope of surviving now that Cohen is no longer involved? Hi, and welcome back to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we get started, make sure to hit that thumbs up, and if you're new to this channel, subscribe and turn on the notification bell to stay updated with our videos. Now, let's get on to the video. With 1,500 stores across the US and Canada, Bed Bath & Beyond are among North America's biggest retail outlets. Home goods, mattresses, cushions, pillows, and bathroom accessories are just a few of the many items they sell. In the past, Bed Bath & Beyond's success was attributed to two factors. First, they have a vast selection in inventory. Their shelves were filled with various items packed nearly all the way to the roof. The second thing was that they utilized discount coupons more extensively compared to any other retailer. You've probably received a ton of their famous 20% discount coupons in the mail if you live in the United States. Despite the fact that their prices were not competitive with those of other big box retailers, having a substantial coupon at least provides the impression that customers are receiving a great deal. This company's strategy was extremely successful for years. Their annual revenue growth rate has been constant since 2009, reaching a peak of $12.3 billion in 2018. They also constantly reported net profits, but starting in 2019, their revenue started to drop rapidly, and the company's most recent fiscal year saw revenues 36% lower than their peak. The decline was caused mainly by two factors. First, other big box stores like Walmart and Best Buy get their merchandise directly from suppliers in nations like China and Vietnam. It is operationally challenging, but offers a significant cost advantage to manage relationships with thousands of small suppliers. However, Bed Bath & Beyond used third-party intermediaries to oversee the international supply chains. Organizationally speaking, this is considerably easier, but the middleman gets a big cut. Even with their large discounts, Bed Bath & Beyond's merchandise was more expensive than those of rival businesses like Walmart. In the past, Bed Bath & Beyond stores carried such a wide variety of merchandise that some customers were prepared to spend a little more for the convenience. The growth of e-commerce, however, made it simple to compare prices on websites like Amazon. It became increasingly more challenging for customers to justify making purchases at Bed Bath & Beyond once they realized how much more they were paying for same products as compared to other retailers. Being a publicly traded company, Bed Bath & Beyond may have given more attention to its share price than to the importance of its necessary supply chain investments. They spent close to $10 billion repurchasing their own shares during the last 10 years, and they were able to reduce their share count by about 70%. Buying back shares will raise share prices since each share reflects a higher ownership stake, assuming the business overall value remains constant. However, in the case of Bed Bath & Beyond, the company's revenue and profitability plummeted so rapidly that the share price fell despite all the buybacks. The total cost of their buybacks is about 1/10 of their current market cap of $855 million. In 2019, 3 hedge funds acquired 5% of Bed Bath & Beyond. They pushed for extensive changes, such as the CEO's replacement. They were granted their requests in November 2019, and Bed Bath & Beyond fired the previous CEO and hired Mark Tritton, a former Target executive. Tritton had a massive strategy for modernizing Bed Bath & Beyond for the 21st century. Among Tritton's plans, one of the biggest was redesigning the stores and cutting down on the amount of merchandise for sale by up to 40%. It was no longer the time for enormous shelves extending to the ceiling, and the new design was much simpler. They also began purchasing products straight from suppliers, taking away the intermediaries. Last but not least, they introduced an extensive range of exclusive brands only sold at Bed Bath, like the Our Table cooking brand. However, because of the pandemic, many of Bed Bath & Beyond stores had to be temporarily closed, impeding these turnaround efforts. By 2021, the COVID lockdowns had ended and customers had received a large sum of stimulus cash. As customers rushed to leave their houses, most retailers experienced huge surges in profits. However, Bed Bath & Beyond was an exception to this. They have experienced more than 40% decline in revenue over the last 2 years. Their revenue in the most recent quarter was marginally lower than at its lowest level during the COVID-19 pandemic, and their financial losses have skyrocketed as a result of declining revenues. They recorded a $358 million loss in the most recent quarter. Keep in mind that they have spent several billions of dollars on share acquisitions over the years, leaving their liquidity situation in a critically tight position. If they don't receive new financing, they might file for bankruptcy within a year at their current rate of cash burn. So what went wrong? Supply chain complexity was greatly exacerbated by Mark Tritton's effort to introduce new private label brands. This meant they were particularly hard hit by the post-COVID supply chain difficulties and had issues finding the products customers were looking for. Additionally, despite their efforts to obtain merchandise directly from suppliers, their pricing remained below compared to competing retailers and e-commerce. Many vlogs on YouTube depict empty Bed Bath & Beyond stores filled with costly items that nobody wants to purchase. In addition, Bed Bath & Beyond's stock price declined amid the brief short squeeze during the meme stock mania of early 2021. This now brings Ryan Cohen into the picture. Chewy, a pet e-commerce platform, was founded by Cohen. He developed a huge following among retail investors by starting an active mistake in GameStop that ultimately led to its historic short squeeze. He is GameStop's chairman and has promoted several business expansion strategies, such as a new NFT platform. Between January and March of 2022, Cohen acquired a 9.8% ownership share in Bed Bath & Beyond. In a letter to the board of directors, he urged them to consider strategic methods. He argued that CEO Mark Tritton should have put more effort into addressing the problems with the supply chain before launching private label brands. He also suggested that they sell the Bye Bye Baby brand, which, in contrast to Bed Bath, would be worth more as a standalone business. The proceeds could be used to reduce debt and make investments in the company's core operations. CEO Mark Tritton was then sacked when the business reported a devastating quarterly loss, fulfilling Cohen's request. Many investors saw this as an indication that Cohen was becoming more influential at the company and would eventually take over as chairman like he has at GameStop. Shortly after Cohen disclosed his stake, the share price increased. But because the business kept burning through cash, it continued to decline over the preceding months. However, the negative momentum abruptly changed direction around mid-August, and within a few weeks, the share price doubled. So what happened? Over the preceding months, the short interest had been rising significantly. It climbed to more than 30% of the free flow in the middle of August, a very considerable percentage. What's more intriguing is that Ryan Cohen submitted a regulatory file indicating that he may sell his entire stake in the business. This may seem strange. Why would the stock rise when Cohen claims that he may be thinking about selling? To answer this, Wall Street Bets posted last August 16th about Cohen's regulator filing. He stated, RC has increased his stake and now has 11.8% of the flow of Bed Bath & Beyond. He filed for the right to sell his stake so that he can benefit from the squeeze just like the rest of us when it occurs. According to the filing, Cohen beneficially owns 9.45 million shares, or 11.8% of the business. It appears that he purchased more shares because, according to the prior filing from March, he only possessed a 9.8% ownership. But if you look at how many shares he actually owned, it was 9.45 million, the exact amount he had in August. But because Bed Bath & Beyond's share count fell during this time, his ownership interest rose. And between March and August, he had not bought a single additional share. To further complicate things, Bed Bath & Beyond issued a formal statement in which they expressed their satisfaction at having a constructive agreement with RC Ventures in March and their dedication to maximizing value for all shareholders. Ryan Cohen's investment firm is called RC Ventures, and they provided very little information on the nature of this constructive agreement. Would Ryan Cohen become a more involved member of the company in the future? Why would they make this announcement a day after Cohen submitted paperwork indicating that he might sell his entire stake? On August 18th, Cohen said in a regulatory filing that he had sold all of his stake in the company. Before stabilizing, the share price began to drop precipitously, losing 67% of its value. More than $1 billion worth of market value was wiped out by this. About $121 million were spent by Ryan Cohen at the start of the year to purchase a stake in Bed Bath. With a profit of $68 million, he made $189 million from the sale. The question now is whether or not Ryan Cohen engaged in market manipulation. With such a massive following within the retail investor community, it makes sense that his prominence as an owner of a large stake in Bed Bath & Beyond would significantly impact the stock's performance. However, you are under no obligation to keep your company shares forever just because you made the first investment. Despite giving only 1 day's notice, he did complete the necessary paperwork to let the public know that he had sold his stake. In March, he claimed he had long-term plans and strategies for Bed Bath & Beyond that might boost shareholder value. Presumably, after his ideas are carried out, the value of the company's stock should increase, allowing you to sell it at a profit. The strategic plans may have been furthest thing from his mind. He could have purchased the shares because he anticipated a short squeeze in 8 months, brought on by his increased ownership percentage as a result of the buybacks. Obviously, this calls for four-dimensional chess skills, which not even Cohen is likely to have. Cohen more likely bought his stake in March with a fervent belief that he could save the company. However, as the months passed, the company's operating performance declined far more rapidly than he had expected. For all he knew, the short squeeze was his last chance to make a profit before the market crashed. The opportunity presented itself, and he jumped at the chance. Of course, all these are just speculations, and Cohen hasn't yet made any remarks on the matter in the media. It's important to remember that Cohen wasn't the only person to profit significantly from the Bed Bath & Beyond short squeeze. Jake Freeman, a university student, spent $25 million he received from his uncle into the stock at $550 a share. When the stock squeezed to $27, he was astounded and instantly sold his holding for a $110 million return, almost twice what Cohen earned. It appears that we have reached the end of this video. Thank you for watching this far. Please subscribe, give a like if you enjoyed it, and comment your thoughts below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe, and I'll see you in the next video.